Good morning or good afternoon to everybody. I wanted to welcome you to the third virtual event with the Economic Club of Las Vegas with Tim Price to discuss global trends and capital preservation in a difficult world with coronavirus. Welcome and thank you for joining us. The Economic Club is a nonprofit, nonpartisan forum for economic discussion. We bring experts on regional, national, and international issues to our Las Vegas audience, allowing us to hear from experts and offer our own questions and ideas in return. The club was formed in 2013 and is also an affiliate chapter of NABE, the National Association for Business Economics. Before we begin, I would like to recognize the hard work of our board and officers. Without their commitment to the club, these events would not be possible. I would also like to thank our sponsors for their generous support, both in terms of financial support and in helping to spread the word about the club. The agenda for today includes, first we will have Mr. Price's presentation, and then we will have a moderated Q&A. At any time during the event, feel free to submit questions to our moderator, Ken Heck, who will organize and present all the questions to Mr. Price. You do not have to wait till the end of the presentation like we have when we did these live. Just send them in when you have the question. Mr. Price has spent the last 25 plus years in the capital markets. He spent 15 years as a discretionary multi-asset portfolio manager and chief investment officer at 3 successive firms, including Henry Ansbacher, Union Bancaire, and PFP Group. He was shortlisted for 5 consecutive years in the UK Private Asset Managers Program and a winner in the category of defensive investing. He's also a columnist for Money Week magazine.
Hello, everybody, and thank you to the Economic Club of Las Vegas for this kind invitation to speak today. Okay, so just a quick bit of reiteration. So I've been a discretionary manager now for 20 years. I started my career as a bond salesman, including some time with the French bank Paribas in the 90s and then with Merrill Lynch in London. And at Merrill Lynch, I've moved from the debt markets into private client portfolio management, which has been my focus ever since. So let's kick off. Next slide, please. So firstly, what do we mean by value? We're value managers. Value gets a bit of a bad rap. But if you take the long view, I think I hope I'm going to make the case for value as a defensible asset choice, asset allocation, and investment choice. This first slide may be familiar to many of you. Any one of you that knows James O'Shaughnessy, his book "What Works on Wall Street." I think this is from the 2003 edition. But basically, James took the entire U.S. stock market. And then split it up into basically split it up by sector. So he split up the 50 highest stocks on a price to sales ratio basis and the 50 lowest stocks on a price to sales ratio basis. He did the same thing with price to cash flow, price to book, and price to earnings. And then every year over the course of 50 years, he reweighted that portfolio of stocks so that it consistently had every year the highest and the lowest ranking stocks within each of those segments. My favorite here is probably price to book because it tells the most extreme story, but you can see that the trend is the same in each case. If you accept the thesis that high price to book stocks equate to, for want of a better phrase, growth, and low price to book stocks, this is where the magic of this presentation comes in. So if you put $10,000 50 odd years ago into the 50 highest price to book stocks in the US market, your $10,000 would have ended up being worth just over $260,000. And you think that's not a bad return. If you'd put that money instead, that $10,000 into the 50 lowest stocks by price to book, your initial investment would have compounded to $22 million. So assuming that any of these metrics have any relevance going forward, and I accept that price to book in particular is a contentious one, it's not really the issue. The issue is on pretty much every ranking, stuff that's cheap ended up wildly outperforming stuff that was expensive, if that 50-year period was any guide. So here we see a variation on the same theme. This is from Rob Arnott's Research Affiliates. and this is a more recent study. So this is the US stock market broken down by 4 categories: value, momentum, quality, and growth. And exactly the same experience, basically. What I found extremely interesting from this analysis over the period 67 to 2016 is that 2 of those categories continually made better than market returns, better than the index return. 2 of them did worse or significantly worse. The 2 categories, the 2 sectors, the styles, if you like, that outperformed the index were value, followed by momentum, the trend, if you like. Both quality and growth actually detracted from the index return. Now, we'll touch on this again at a later point, because obviously certain growth stocks have been wild outperformers over the last 10 years, but over the last 50, it's been a different story. So I would argue that the conventional wisdom with regard to value investing, particularly in the equity market, contains the following 5 presumptions. Firstly, that value is some kind of bet against technology. Now, I apologize that I'm not visually I'm not visible to you at the moment, but that's because I know nothing about technology. But notwithstanding that, we are willing as a firm to invest in the technology sector, but it would be fair to say that, a bit like Buffett, we don't claim to understand it that well. More to the point, it's very fast moving. But that doesn't mean that we preclude it as an investment choice. The reality, however, the sad reality for us is that technology stocks per se tend never to be cheap enough for us to consider buying them, because we have a global sweep across markets. We can invest on an unconstrained basis wherever we wish. And as a result, we tend to go on a Benjamin Graham basis where the value is the most explicit. I think a second assumption about value is that the rise of big data, the rise of social networks, the big new media businesses, the Facebooks, the Apples, the Amazons, the Googles of this world, is leading to more value traps. In other words, there are plenty of companies that aren't participating in that, and they're being frozen out to those prospects of growth. Maybe, maybe not. Time will tell. The third presumption is that the world has somehow changed from, let's say, those prior examples when value was the best performing strategy of any, or was certainly an independently successful strategy in its own right. Now, for sure, we could make a case today that the world has changed as a result of coronavirus, but that's not really the point I'm making. I'm simply saying there's a presumption amongst investors, particularly growth investors, that the world has somehow changed permanently and value isn't coming back. I would gently challenge that thesis. One manager I saw recently in some research suggested that too many people are doing it. I think they were referring to value investing. I find that an astonishing suggestion. I can barely find anybody that's realistically doing value investing. So the idea that we're somehow in the majority strikes me as akin to wishful thinking. And the fifth presumption, which I think offers one of the most attractive investment opportunities globally today, is that at least recently, and arguably even now, very few friends for the commodities sector. And as we'll see in perhaps a chart later, the commodities sector is now trading relative to stocks, and in particular relative to US stocks, at the cheapest level for perhaps 60, 40 or 50 years, perhaps 120 years. Either way, the commodities sector is one of those areas of the market that I think is perhaps the most fascinating today. So value versus growth. We can debate precisely what these things mean, but here we're just deferring to MSCI as an index coordinator, as an index aggregator. So here you see a chart going back to the 1970s, mid-70s, of MSCI World Value versus MSCI World Growth. What I find astonishing about this, well, the first thing I'd highlight is you can see the peak of the first dot-com bubble or boom, and it's basically early 2000. So March 2000 was the then all-time high for the Nasdaq index, and you can see that back then growth was extraordinarily had extraordinarily outperformed value to that point. What I find incredible about this chart is that where growth now sits, as far as MSCI is concerned, growth stocks are even more expensive relative to value stocks now than they were at the height of the first dot-com boom. I think that may prove to be a warning sign, but again, time will tell. So what does growth really mean? It means different things to different people in the same way that value means different things to different people. One thing I think we can probably agree is that the market has become highly bifurcated. It has become highly concentrated. And for global equity investors, they've really only had to make two decisions over the last 10 years or so. One was which market to be in, and the answer was the US. And the second decision was which stocks to own in the US, and the answer was you basically bought the so-called FANGs: Facebook, Amazon, Netflix, Google, and the big six of Facebook, Amazon, Apple, Netflix, Google, and Microsoft, which is basically the FANGs plus Apple and Microsoft, over a 10-year period, or over the most recent 5-year period, the FANGs, that half dozen stocks in the tech sector, basically gave you a 300% return. If you owned the entire S&P 500, you earned 72 and a bit percent. So it was like a one or two decision outcome. You simply had to own those stocks, and you could forget the rest of the world. It's worth maybe thinking a little bit about what growth means in terms of some of the metrics. So forward P, price to book, that we cited earlier, I freely accept is probably of historic interest given the nature of the modern technology sector, where a lot of where a lot of market value is in intangible things like brand, intellectual property, and so forth, which are difficult to account for on the balance sheet. But if we take PE, I think that's a much fairer, a much broader metric that you can apply to basically any company quite fairly. And here you can see the forward price to earnings ratios for, again, some of these glamour stocks. Now, I'm not for a moment suggesting that any of these metrics or any of these stocks are overpriced. I'm merely suggesting that they are, in many cases, priced for something close to perfection. The one I would highlight would be Netflix. Now, Netflix clearly has been a bit of a winner from the coronavirus crisis, to the extent that turns out if you put half the world under house arrest and force them to make their own entertainment, they're going to migrate online and watch films. So Netflix has been a huge beneficiary, but I'm not convinced that that's necessarily a lasting trend. So it may be that many of these metrics are entirely defensible, but I question the defensibility across the piece. So let's have a look at some of the macro backdrop then. As we came into this crisis, the coronavirus crisis, the world was nursing the highest debt levels ever, particularly in the context of the government bond market. There was something like $17 trillion worth of debt trading with negative interest rates, which I think for most people is some form of economic abhorrence. The very idea is abhorrent. CLOs back in the news again, popular. Low doc loans are the norm again. It's like 2007, 2008. The global financial crisis never happened. Bond ratings are significantly lower than they've been in the past. So the average credit rating is much worse than it's been historically. Even before the pandemic began, IPOs were starting to either weaken strongly after launch or actually be pulled ahead of launch. For example, WeWork. The public issuance of unprofitable business exceeds the IPO issuance of 1999. So once again, history potentially repeating itself in terms of dot-com style euphoria. Student loans are big. Car loans are huge. We have an ongoing rancorous relationship between East and West, particularly between the US and China in terms of trade, in terms of tariff negotiations. To an extent, there's concern on the margin that jobs are migrating from the human economy to the machine economy. Even before the coronavirus pandemic began, there was some mistrust of the capitalist system and rising support for socialism. And I think one factor behind, or one aspect of the coronavirus pandemic, is that it is ushering in rising support for, let's say, a more socialist view of the world. One question: will MMT, so-called modern monetary theory, essentially the idea that governments never need to worry about money printing or the issuance of debt because they can always print more money to service the debt, for any government, for example, for any government or economy that can issue, that is control of the printing press, will modern monetary theory be the next rabbit out of the hat? Now, when I put this presentation together earlier this year, That was a hypothesis, but MMT now effectively has already happened. Maybe not explicitly, but certainly implicitly. I was shocked to find out, for example, that the amount of money printed by the Fed in 2 months this year is more than half of what the Fed printed in 6 years of QE at the height of and after the global financial crisis. MMT, I would argue, is already alive and well and with us already. And here in the UK, I can't speak for the States, but here in the UK, already widespread discussion of things like universal basic income. In other words, we all get paid regardless of whether we work or not. Perhaps the most critical question of all, and it may be not easy, maybe impossible to answer, is what is the future outlook? Is it one of deflation or is it one of inflation? I would argue that the balance in that debate at the administrative level is certainly shifting. So this is a headline from the London Financial Times. US Federal Reserve considers letting inflation run above target. I would merely suggest that if history is any guide, once you let inflation out of the bottle, it can be problematic, at least, to get it back in again. So if our thesis, if our fear of inflation to come is remotely relevant, remotely accurate, what might make sense as a means of mitigating against that risk in terms of portfolios? So our business is ultimately about private client, high net worth private client portfolios. And for many of the clients we work for, if not all of them, the assets we're talking about are sacred assets. They're irreplaceable assets, particularly those who are pensioners. That asset, that capital base, is not replaceable through employment, so it has to last. Again, we look back to what's happened previously in history, and perhaps the fairest historical analog to what we're going through now in 2020 is not the Great Depression of the 1930s. It's not the Second World War, when there was real impact both in human lives and in terms of industrial plant. So basically whole economies were literally razed to the ground. Perhaps the fairest historical comparison is actually with the 1970s, with a period of stagflation. In other words, inflation, but with no attendant economic growth. And during the 1970s, which clearly was impacted by 2 oil shocks, by President Nixon taking the dollar off gold, so removing the convertibility between the US dollar and gold, and then a variety of sort of social. So it was a difficult decade. Let's just say that. During that period, CRB commodity index went up 100 to 285. So if history is any guide, commodities can conceivably offer some form of portfolio hedging at a time of not necessarily even economic growth, merely stagflation. So another thing that can clearly work and has worked historically in relation to a hedge against inflation, we're of course talking about gold. Now, for anyone that hasn't seen it, I would thoroughly recommend a quite magisterial piece of research done by some people at Incrementum in Austria. And they're gold specialists, and they have an annual piece called "In Gold We Trust," which is available from their website. And it's I think this year the longer form version is 356 pages, so it's perfect bedtime reading. But here's just an example of the gold price 71 through to last year. They've recently added the data to include 2020, and basically whichever currency you express it in, whether you're talking about dollars, sterling, euro, yen, renminbi, Swiss franc, whether we're talking about G7 currencies or emerging market currencies, over the last, certainly I think since 2001, the gold price has risen on average, in other words, for the last 2 decades, by very, very roughly 10% per year. And bear in mind, that's an asset that doesn't even give you a dividend. So it doesn't give you any income. Notwithstanding that, it's been one of the best performing asset classes in the world. In light of both the monetary and fiscal stimulus that's been announced and is almost certainly to come, I would simply suggest that it is not too late to invest in gold as a form of portfolio protection, as a form of currency protection, as a form of inflation insurance. And here we go. So this is the chart I was alluding to. So this is a slightly old table, but the latest piece of Incrementum research has the full 2020 data. And you can see whichever currency you express it in, Gold's been a very decent performer. The caveat has to be, yes, it hasn't risen in a straight line. So clearly 2013 was a poor year for gold. 2015 was a somewhat poor year for gold, but in the greater scheme of things, gold has acted as a very good inflation hedge over the last 2 decades, and I would expect it to continue to maintain that role, in large part because at an institutional level, it is barely owned at all. I think the current stats would suggest that the institutional ownership of gold amongst institutional portfolios is of the order of perhaps 1% of total global capital. So that 1% doesn't have to go up very, very far, and that will have a meaningful impact on the gold price. So I've talked a little about gold, about the commodity sector. For us, we would rather own a process than a product. So in other words, we would rather own commodity businesses, necessarily well-run commodity businesses that are fairly priced, than simply the commodity itself, because then you can benefit from human ingenuity and human capital. And so what we do is we use exactly the same characteristics for commodity sector companies as we do for companies that are in other sectors. And so the things that attract us particularly are a history, an impressive history of shareholder return. So we're looking for return on equity. We are looking for companies that have little or no attendant debt. That was the case before coronavirus. It is even more the case now. Many US corporations, as you'll be well aware, are coming into this crisis with more leverage than they've ever had. So not all of them are going to make it through to the other side. We're also interested in cash flow from operations. So we particularly rate strongly cash flow generative businesses, and our target level from a cash from operations yield, which can be calculated by effectively inverting enterprise value by cash flow from operations, that ratio is a 10% cash from operations yield. So we want companies that are significantly cash generative, but with little or no debt attached. So here's just an example. Ramelius Resources, Western Australian-based gold miner. It's been one of our best performing investments of late, and it's still what we would consider relatively inexpensive. Another example of a stock that we have owned for clients, I'm not sure we own it in our fund at the moment, but we certainly have owned it, is Boliden, which is a Swedish base metals miner and smelter. But again, very little debt, fairly high or very high cash flow from operations yield, and attractive return on equity. And finally, maybe last but not least, one of the stocks that we still own, and very happy to do so, Fresnillo, one of the world's largest silver miners. And again, we're seeing all of the same kind of characteristics: decent cash flow yields, relatively low debt, and quite a high return on equity historically. Now, in the context of the UK, the major political turmoil that we've had to live through over the last few years until the pandemic came along was Brexit, and also the risk of a hard left Labour government. Those risks were basically put to bed just before Christmas with the election of Boris Johnson's Conservative Party with a fairly significant majority in Parliament. So in many senses, I mean, obviously the pandemic crisis is now the prevailing issue of our time. But putting that to one side, outside that, the political class had definitely improved in the UK. And these are three companies that certainly met our requirements. Aggreko, which is a temporary power generator company. IG Group and CMC Markets are both alternative investment platforms, trading platforms, if you will. And again, each of them meet our criteria in terms of things like return on equity, cash from operations, and relatively low debt levels. So the final word, and there will be a bit more, but I'm in the process of wrapping up, but the final word really goes to our mentor, not just our mentor, but of course Warren Buffett's mentor, Benjamin Graham, who wrote the book, The Intelligent Investor, that we use as something akin to a Bible. Buy not on optimism, but on arithmetic. In other words, it's not about what might be coming to pass, but simply what already stacks up as an investment. And even if nothing substantially changes, assuming that the future is very much similar to the past, things that are very sensibly fairly priced and already highly profitable probably aren't going to be bad investments going forward. And now I have just a few slides to sort of conclude on a more general basis. So these are some of the characteristics we look for in terms of other funds. So we have just one fund, which is a global equity fund, a global value fund, as you can appreciate. But we're perfectly happy to work with other managers. we want to maximize the opportunity set for our clients. We're a small boutique based in London. We would like to have the facility to invest in other markets, but if we're going to do that, if we don't know those markets, then we're going to partner with people based with boots on the ground in those markets who think hopefully the same way we do. So we look really for pretty much all of these characteristics in terms of potentially partnering, co-investing with other fund managers. Clearly, we're looking for an explicit commitment to value investing. We like independent owner-managed businesses where we think there's the fairest alignment of interests. We like people of quality and integrity. We like a clear process and a competitive edge. These people have to be focused on performance, so that's the be-all and end-all. Fundamentally, we're looking for people who are good asset managers, not people who are simply good at gathering assets. We like to see people with meaningful skin in the game. We like to see a simple business model. In our world, we tend to use what are called UCITS funds, which are the outside the US, the sort of onshore regulatory standard. We need, for obvious reasons, we like to see independent administration and audit. And we're also wary of large funds. So we would much rather deal with boutiques like ourselves, where, again, asset management comes to the fore and asset gathering is largely irrelevant. This pie chart gives you a sense of how one of our typical client portfolios will look. So the size of the pie, the size of the portion of the pie will give you an indication of what the percentage allocation is to that asset class. So as you can see, a fairly meaningful allocation to value equities or perhaps specialist funds. Fairly sizable allocation to uncorrelated or absolute return funds. Those are effectively CTAs or managed futures funds. Meaningful allocation to real assets, predominantly the monetary metals, namely gold and silver and related equities. And then a fairly modest allocation to what we call cash and bonds, but which is effectively all cash. We don't have any bond investments to speak of now for what are probably obvious reasons. The bond market is more expensive now than it's been for 5,000 years, so we think we can find better fish to fry elsewhere. I mentioned CTAs or managed futures. For those people who may or may not be familiar with the managed futures, these are simply momentum-based, largely algorithmic-based, systematic strategies. So that these are simply funds that track trends in prices. Those prices might be in equity indices, they might be in currencies, they might be in hard commodities like zinc and copper, or soft commodities like corn and wheat. We're simply looking for managers that actively track those markets and then trade them to exploit strong trends as and when they arise. Trends in both directions. So these funds are just as happy to buy and as they are to sell. They're happy to go short markets too when the trend dictates. And this is just a few historical examples of when equity markets in particular were rocky, and managed futures in most cases has breezed through those periods of volatility. So I would always make a case for managed futures as part of a diversified portfolio, because if nothing else, they are a degree of insurance against our own overconfidence. Very, very. I think I've only got two more to come. This is how we define value, and it's all again through the prism of Benjamin Graham's margin of safety. So for us, to get a margin of safety means specifically ideally a minimum 10% cash flow from operations yield, a P ratio ideally of less than 15 and single digits if we can get it. Price to book in as much as that metric is relevant of less than 1.5 times, ideally less than 1. Low debt to total assets. We want to see cash from operations growth. We want to invest in growth, though we don't want to pay high growth valuations. High return on equity is stated. And we're also perfectly happy to consider buybacks. So buybacks also get a bit of a bad reputation. But we're perfectly happy for companies to indulge in share buybacks, provided they're done at the appropriate level. So if they're done at a very low multiple or no multiple to inherent worth, then that's fine. But if companies are buying back their stock at ridiculous multiples, then that's a waste of shareholder capital. So to sum up, I think this is the pre-ultimate slide. Confronted with a challenge to distill the secret of sound investment into three words, we venture the motto margin of safety. Those words from the master himself, Benjamin Graham, in The Intelligent Investor, published in 1949. And then from the other master, Warren Buffett himself, 42 years after reading that, I still think those are the right three words. So why value as a watchword across the board within the context of a portfolio? Again, we'll give the last word to Mr. Buffett. I can only tell you that the secret has been out for 50 years, ever since Benjamin Graham and David Dodd wrote Security Analysis in 1934, and ever since Ben Graham followed up with The Intelligent Investor in 1949. Yet I have seen no trend toward value investing in the 35 years that I've practiced it. There seems to be some perverse human characteristic that likes to make easy things difficult. There will continue to be wide discrepancies between price and value in the marketplace, and those who read their Graham and Dodd will continue to prosper. To which we can only say amen to that. And then the all-important last regulatory slide. So that concludes my presentation. Thank you for your kind attention, and I think and hope we can open the floor to any Q&A.
All right, this is Ken. I'm the president of the Economic Club of Las Vegas, and I have just shared to everybody a message that says if you have a question for Mr. Tim Price, please submit them through this chat, and I will be receiving them directly, and I will fold them into the moderated Q&A session. Tim, I have to thank you. That was a very, very insightful and engaging presentation. I appreciate that. And thank you for presenting with us and being available today.
Thank you.
There's a few definition questions that came through while you were presenting, and I wanted to ask you to please present them. And also, your final slide was a wonderful segue into one of the questions. So let's do some quick definitions.
Sure.
Could you please describe what is a value trap?
Sure. Well, firstly, let me describe what a value investment is, as at least we define it. So it's important that we define our terms. So for us, value is something specifically you can measure in the stock market. It's not possible to measure a trend following fund as a value fund because that's a trading strategy. It's not price dependent with price as some kind of objective thing. So when we talk about a value equity, what we're effectively looking at is the following. It's a high quality business run by principled, shareholder friendly management who have a superb track record of capital allocation, where the shares of that company, the listed shares of that company, can be purchased at a level at or below what you consider its inherent or intrinsic value. So the crude way of describing it would be we're buying dollar bills for 40 cents. And a value trap is something that you think is a value investment, but it stays cheap. It never, ever rebounds to what you might consider as a much fairer, higher valuation. So value trap is a cheap stock that remains cheap forever. Thank you for that.
All right, so let's go ahead. Your last slide talked about Warren Buffett and his incredulousness at the fact that nobody was grabbing onto value as an investing style. Can you talk about how in the aughts, in 2004 through 2009, and for the last several years where we've had very strong growth runs, can you do your best to surmise why investors are having a hard time holding on to a value style?
I could give some ideas. I don't think I could give a definitive answer because I'm not sure anybody could, because you'd need to have perfect information about all assets and prices in the world. One, I think, plausible thesis is that the rise of passive investing in ETFs has played a part, because you're looking at, this is a flow argument, that so much money is being put into the market on an indiscriminate basis. Let's just buy the S&P 500, for example, that the value guys have been completely swamped by that process. So on a flow basis, so I used a slide where I think someone allegedly said, well, too many people are practicing value investing. I think that's a complete joke. As far as I can see, virtually nobody, including Buffett, is practicing value investing anymore. So I think that's probably played a role. The other thing I would suggest, and I should probably declare my allegiance as a sort of card-carrying member of the so-called Austrian or classical economic school, which, if anyone is interested and is unfamiliar with that term, then I would define the classical or Austrian school as basically people who believe in sound money, small government, and broadly libertarian principles. As an Austrian investor, I would say that one of the reasons why value has had a tough time is because we don't have free markets anymore. We have state-directed markets, and you have this overarching player in the market in the States called the Federal Reserve. And the Fed isn't acting in isolation, because one of our favorite markets at the moment is Japan, but we have to be mindful of the fact that the Bank of Japan, firstly, that the Japanese government is hopelessly bankrupt, and secondly, so in other words, I don't think any rational investor would be touching Japanese government bonds at these kind of zero or negative yield levels. But secondly, the Bank of Japan now owns, I don't know exactly how much, but it's a meaningful slug of the entire Japanese stock market. I get extremely queasy when governments or their agents, the central banks, start owning stocks, because that's not the role of government, in my view. So I would define, to answer the question, I'd answer it in those two ways. Firstly, the rise of passives, and secondly, the fact that there's a lot of government distortion in markets today.
A thought came to my mind as you were answering that question, and it occurs to me that if different index companies had been better at marketing than Standard & Poor's, perhaps there might be a little more of a slant towards value.
Perhaps so. I mean, the thing is, I'm loath to be critical, particularly since I don't necessarily know who all of your sponsors are, so I wouldn't want to embarrass anybody. But I'm mindful of the fact that let's say an index provider, who shall remain nameless, has a growth fund and it has a value fund, and Microsoft appears in both of them. Well, I'm sorry, but this is where you start to see the absurdity of some of these things. This is why definitions are so important. But this is not a criticism of Microsoft, by the way. But if the same company can be both a growth and value stock simultaneously, then we've entered some kind of is it Heisenberg's uncertainty principle world, where the laws of quantum mechanics now seem to be applying.
First of all, I need to state that, again, thank you for your comments. And the views of our presenter are not necessarily the views of the Economic Club of Las Vegas. And now you can say whatever you'd like to say. One of the questions is, you had started talking about valuations and loose monetary policy and the rise of MMT. Are you expecting an inflationary period over the next decade or however long? And I'm gonna combine that with a question where someone was asking that we were expecting inflation post housing crisis in the United States, where the government injected a significant amount of money, and that never developed. We didn't see that high inflation. How is this going to be different if you are expecting high inflation?
Sure, both really good questions. So to answer the first one first, yes, I am expecting inflation, though, by the same token, I've been expecting inflation since QE in 2008. So again, it's been a long journey. As to what, and I may not be right. So again, I'm only advocating a personal opinion. So firstly, why do I expect that? Well, so here's the very brief answer. My background, if you like, is in the bond market. So I consider the bond market as sort of home territory, home turf. There's never been more debt in the system. If you accept the thesis that there's too much debt globally, both government and also corporate and household, but specifically government debt, then there's only three ways that debt predicament can be resolved. The first is that you resolve it through government's engineering enough economic growth to keep the debt serviced. I would argue that coronavirus is the game changer, and that's now made that economic growth impossible, at least in the short to medium term. The second box as a resolution to the debt predicament is, well, we can call it default, we can call it a debt jubilee, we can call it some form of reset. But the reality is that we also operate in a credit-based economy globally, and any form of meaningful default would be economic Armageddon that would almost instantaneously bankrupt the pension system. So let's assume that's not going to happen. So then the question is, well, what's in box number 3? Well, what's in box number 3 has been in box number 3 and has been the thing that all heavily indebted governments throughout all recorded history have ultimately resorted, and it's called inflation. So then to answer the specific second question, what makes it different this time? We did a podcast with Russell Napier, who's a financial market historian, about 2 or 3 weeks ago. And we asked him exactly the same question about, why inflation this time, given that we couldn't get inflation out of QE the first time. And his answer, I hesitate to put words in somebody else's mouth, but essentially, as I recall his answer, back in the global financial crisis and the 10 years subsequent, yes, you had central banks printing money like it was going out of fashion, but the commercial banking system, the private banking system, but put it this way, the central banks were filling the bathtub as fast as they possibly could, and the commercial banks were pulling the plug at exactly the same time. So no matter how much money the central banks created, the commercial banks were basically destroying it through credit contraction. So you never had the takeoff of inflation. I said earlier we should define our terms. What is inflation? I would define inflation, again, like any classical or Austrian economist. Inflation is an increase in the money supply. The inflation has already happened. What we call inflation by way of a rise in the price of goods and services is a second order effect. And I simply say give it time. But again, to go back to the second person's question, I think what will make it different, what could make it different this time, is that the governments now have, at least in the US and the UK and the Eurozone, and also in China and in Japan, so basically everywhere, governments have a higher level of control over the private banking system than they did before. That they will basically tell the banks whatever they want the banks to do. And so if the government says jump, the banks can only now say how high. In other words, I think the difference now is that the entire economy, the entire financial system is more closely under the influence of the big state. That's why I think inflation is more likely to happen this time around.
Well, given that position, you talked about your theories and your ideas about investing in gold. What is the best way for an investor to initially get exposure, say a broader exposure to gold, rather than buying an individual closely held securities?
Sure. So the best way I could describe it is simply to describe what we do with our clients. So assuming our clients come to us without any prior gold investments, and in many cases they already have some gold exposure, but assuming that you're starting with a clean slate, what my best advice would be, in this environment, it seems to me there are so many risks out there. There were so many risks coming into 2020 without coronavirus, and then the risk, the Overton window of potential risks has just been exploded wider in every direction. So the first thing I say is you cannot be too diversified now. It's impossible. In other words, it makes most sense at a period of high risk to have more diversification than you ever had before. So the way we would recommend doing it would be, firstly, you want to have some the pure bullion exposure, and that could be through physical bullion held in a safe, in a vault, privately, or there are clearly various options. But in either or through an ETF that doesn't lend out that gold, doesn't rehypothecate it. But firstly, I think the answer is you have the physical asset. And I think at the moment there's an opportunity both in gold and also in silver, because the silver to gold ratio is so markedly in favor of silver. In other words, silver looks cheap now relative to gold historically. So what we would advocate for our own clients is we start the ball rolling with the physical asset, with bullion itself. Thereafter, with the people who have the risk appetite to do it, we would then advocate diversified large cap exposure to hopefully decent quality companies and at the larger end of the market capitalization spectrum. And then again, for people who've got the risk appetite, to diversify further and go into the smaller cap space. And there's a happy halfway house, without naming names, there's a happy halfway house in what's called the royalty and streaming sector, where you've got companies that operate that are effectively gold or silver miners, but they don't give you exploration or production risk, because they simply acquire the gold or silver that's a byproduct of an industrial miner mining for something else altogether, say copper. And that enables them to get gold or silver, a stream of gold or silver at a sub-market rate in perpetuity, or for as long as the ore body lasts. And that gives them a low risk, that effectively gives you a low risk way of owning a mining stock. So it's a long-winded answer, my apologies for that, but essentially a mixture of physical plus large cap mining plus small cap mining plus royalty and streaming companies. And that would be our preferred way of getting access to the sector.
Thank you. That's not long-winded. I think it's the kind of answers that our audience are looking for. So thank you for that. What is your take on the most recent and dramatic decrease in oil prices and the subsequent meltdown of the oil's futures market?
Good question. I don't claim to be fully au fait with exactly what's going on in the energy sector, except that it is a knee-jerk response. You'd say it's a example of deflation. In other words, a reflection of a huge demand shock, because basically if you're not at work, if industry's idle, then there's just fundamentally less consumption going on, allied with clearly a bit of sort of trade dispute, a bit of trade dispute stress going on as well, and that's what takes us into the sort of geopolitical realm. So you've got US and shale producers versus the likes of Russia and China and all kinds of sort of alternative great powers vying for strategic edge over the opposition. But I think at the heart of it, I still think there are still markets that do reflect economic matters, and I think first and foremost it's simply a reflection of the fact that as you would expect, an industrial cyclical commodity has crashed because at the moment there's little demand for it, and going forward there's going to be lower demand for it.
So as a value investor, is that a market that you would be avoiding or you would be considering?
It's a good question. It's probably too cyclical for our. In other words, one of the most painful thing that we've learned, the most painful mistake we've made over the last decade was, as investors, was when the gold price was falling. Sorry, when the gold price was rising up to, I think the peak was 2011. The most recent peak, I think, was 2011. We kind of lost track of the Ben Graham valuation angle. So we were happy to own gold mining stocks because we were using the overarching thesis, the gold price is going up. And then, of course, the gold price didn't go up, and it turned out that we'd effectively overpaid for the mining companies that we'd bought. And that was a very painful drawdown. So now we take a much more bottom-up driven valuation perspective, which is we'll treat all our investments the same, and there won't be an overarching macro thesis. So, excuse me, we try and steer clear of macro theses because, in at least in personal experience, they're extraordinarily difficult to pull off.
Two questions left to finish up. First is, what's your view on real estate as an asset class compared to other asset classes?
Okay, really good question, quite topical. I mean, here in the UK, and maybe you use the same expression in the States, the argument is always, well, there's three things that matter about real estate, and it's location, location, location. So historically, we haven't used real estate as part of our client portfolios, not because we don't want to, but because is kind of like, if you like, retail investors, we need something that all of our clients can buy, and real estate isn't necessarily a very easily collective, unitized asset to own. We'd much rather own individual things on a bottom-up basis, but of course that's then quite difficult to allocate across clients that join you at various stages in the sort of investment cycle. So it's been problematic for us to use. Good, and others. I think it's like the curate's egg. It will be good in parts. So I think there's undoubtedly potential for it. I think the coronavirus will change the real estate market inevitably, as it will impact on so many other areas of the economy. I was looking at the Economist magazine just before I joined you today, and already they're saying there's evidence of a fairly marked decline in in London residential property prices. Now that doesn't surprise me at all, given the nature of what's happening with the virus and people's responses to it. Namely, would I rather be under house arrest in a tiny overpriced flat in North London, or would I rather be having lockdown in a gigantic palace in somewhere in the southeast in the home counties here? So I think there are going to be impacts. The other thing that concerns me is that I think it really hinges on what happens to interest rates. If interest rates do ultimately rise, which they surely have to at some point, unless governments succeeded in basically squashing free markets forever, then I think there's a risk that real estate will respond as the bond-like asset that it kind of is. So I'm sure there will be opportunities in that sector, but equally, by the same token, I'm unfortunately relatively certain that it's going to be impacted in a negative way, reflecting people's demands in a slightly brave new world sense, but also just the fact that let's say we have deflation first, which wouldn't be unlikely. That's going to be a real headwind for overpriced property.
All right, final topic, because I say topic and not question because I'm going to be blending a few questions together. And so please allow me to give you several questions, and you can coalesce your answer however you'd like to. Someone shared some facts with me, and I did fact check them. The U.S.-China trade relationship, there's $660 billion that trades both ways, broken down to $540 billion imported from China into the U.S. and $120 billion exported from the U.S. to China. Now that's significantly less than 5% of U.S. GDP. So the first question is, why is that the potential trade war and the past trade war between the United States and China so impactful on the U.S. and world if it's such a small percent of GDP? There's another question of talking about China as a bad actor on the global stage, and as the U.S. and the rest of the world discusses and considers decoupling from China, which other countries stand to gain?
Okay, well, that's clearly a topical one. I'd address the bad actor thing first. I think we don't invest in China, and the main reason. Well, I'll give you a sort of anecdotal example. I met a Hong Kong fund manager in London a few years ago, and he just said, I mean, I appreciate there may also be a rising, heightened tensions between Hong Kong and China at the moment. So let's not pretend that's not on the case. That's not on the table either. But what he basically said was, well, if there are 1.3 billion people in China, then it's probably a fair assumption that at least 1 billion of them are crooks. And I thought, well, that's an interesting perspective. So probably the main reason why we don't invest in China is because the corporate governance, simply the quality of corporate governance simply isn't there. And then there are plenty of other reasons on top, the valuation one being key. It's not a cheap market. You might think it is, but it isn't. And then, of course, there's a sort of geopolitical and in the case of coronavirus, just a whole swathe of other issues that would lead one to be suspicious or wary or cynical about China. So the base case there for us is simply, no, we don't need to invest. We're not index assessed. We're not, we're not benchmarked, so we can invest wherever we like. So we'd much rather invest in Japan and Vietnam, for example, which are two stunningly cheap markets by comparison. We would make that case. In terms of the China trade thing, I think I sense that, what coronavirus will also do, and if it's not coronavirus, then it's the way different countries have responded to it. Again, it's not going to reflect China in a good light. So while I accept the argument that China exports a lot and imports comparatively little, that's going to change, surely. We've already seen that Japan, I think, has spent, I think the Japanese government, I think, has already committed to well over $1 billion to reshore Japanese companies that were previously manufacturing in China and is asking them to come back home. I think that's going to happen in spades. I would not want to see an escalation in political tensions with China. I would not want to see a hot war with China, because that's just going to be a disaster. There's no good outcome from that. But that said, let's not pretend that China hasn't been engaged in a Cold War in a variety of media over the last few years, and trade is only one of them. Communications is one, information is one of, there's so technology, there's so much going on. So I would like, and this may be wishful thinking on my part, I would like to think that it might be possible to try and exert meaningful political change on China and on the Chinese Communist Party by way of peacefully saying to them, we've had enough of your bad acting. Please get yourself in order. And in the meantime, we're going to boycott your goods and services in as far as that's practicable. Now, I wholly appreciate that's probably impossible for everybody to do, but it's surely not it's not the worst direction of travel to head off to try and affect a change. This is ultimately, a virus that started in China. Let's not talk about how it might have started. It's simply, we know it started there, and China's early behavior did not exactly make their behavior appealing to people around the rest of the world. So they locked down Wuhan, they welded people into their own homes. They locked down travel between Wuhan and Beijing, but allowed people from the area to travel around the rest of the world. That is not how friends behave to other friends.
And again, I can't speak for the club or anybody. I could not agree with what you're saying any more than I already do. And so with that, I'm going to thank you for your time, Tim. It's been, we are at the hour now, and I want to thank you. It's been, again, a very engaging session. And for those of you who had questions that I was not able to get in under the hour, please contact me, and I will work with Tim to get answers for you directly. And please tune in. We have an event coming up in 2 weeks. It'll be on June 16th. at 10 a.m. Pacific time. We have Alex Ritson from ANPR BBC News, again from the UK, who'll be talking about what it was like to be in the newsroom covering COVID-19 globally, and he's going to provide an analysis of international policy responses. So this one should be pretty heated, and Tim will send you the invitation for that as well.
Thank you very much.
So thank you, everybody, and have a fantastic day.